When it comes to stock investing, there are three questions beginners struggle with the most. 1. Which stock should you buy? 2. At what price should you buy it? 3. At what price should you sell it? These sound simple, but they're surprisingly hard to answer. In this video, I'm going to focus on question number 2. At what price should you buy? The answer is at any price. I know, sounds crazy.
Come on, you can't be serious.
I am, and one of the greatest investors of all time agrees.
So I would pick a broad index, but I wouldn't toss a chunk in at any one time. I would do it over a period of time.
That's the basis of something called dollar cost averaging, or DCA. It simply means buying shares at regular intervals with a fixed budget, no matter the price. So over time, you get an average cost per share. Now, why does this work so well? Because it removes two of the biggest beginner mistakes in investing. First, trying to time the market, waiting for the perfect price that never comes. Second, letting emotions take over, feeling excited when prices rise and scared when they fall. With DCA, you buy in the good months, you buy in the bad months. When the price is down, your same budget buys more shares. When the price is up, your budget buys fewer shares. Over time, those ups and downs average out, and you keep building your ownership without overthinking every move. It's a simple and stress-free way to invest, and it works whether the market is calm, booming, or going through a rough patch.
What really? Is there an example? I don't get it.
Okay, imagine you have $500 per month that you can invest in stocks. For this example, we'll use a fictional company called Vanilla Bank. Right now, Vanilla Bank is trading at $50 per share. With $500, you can buy exactly 10 shares. In the first month, you invest your $500 at that $50 price, so you pick up 10 shares. In the second month, the price drops slightly to $45 per share. That same $500 now gets you 11 shares. In the third month, the price jumps up to $55 per share. So with $500, you can only buy 9 shares. At the end of these 3 months, you've invested a total of $1,500 and you now own 30 shares of Vanilla Bank. If you take the total amount you've invested and divide it by the number of shares you own, your average purchase price works out to exactly $50 per share. Now, if the market price is currently $56 per share, your 30 shares are worth $1,680. That's a profit of $180, or about 12%, in just 3 months. And that's the beauty of dollar cost averaging. You automatically buy more shares when the price drops, fewer shares when the price rises, and over time your average cost smooths out. This means you don't have to worry about finding the perfect moment to buy. You just stick to the plan and keep building your ownership over time. Now let's fast forward to the end of 1 full year. You've been investing that same $500 every month, so you've put in a total of $6,000. Some months, like month 2, the price dipped and you picked up extra shares. Other months, like month 3, the price was higher and you got fewer shares. But across the entire year, these differences balanced out. By the end of the year, you've collected 120 shares of Vanilla Bank, with an average purchase price of $50 per share. If the current market price is $56 per share, those 120 shares are now worth $6,720. That's a gain of $720, or about 12% in just 1 year. And remember, that's only from capital gains. Even if there had been a dip in, say, month 10, your DCA plan would have had you buying more shares at that lower price, which actually helps your long-term results. That's the real power of this strategy, but that's not the only way you make money with stocks. Quick note, if you're serious about starting your investing journey, I've put together a free masterclass where I show my full step-by-step system for building your first stock portfolio, avoiding beginner mistakes, and growing it over time. You can watch it anytime using the link in the description. During that same year, Vanilla Bank also paid 2 dividends. The first dividend was 25 cents per share in month 2. At that point, you had 10 shares, so you collected a $2.50 dividend. The second dividend was $1 per share in month 6. By then, you had 60 shares, so you earned $60 in dividend income. By month 13, if you kept going with this DCA strategy, you'd have 130 shares. If Vanilla Bank announced a 40-cent dividend, you'd collect $52, just for owning the stock. Not bad for simply sticking to your plan and investing consistently. Now, let's clear up a common misconception. Studies show that if you invest a lump sum right away, you often make more money than spreading it out. Why? Because historically, the market goes up more often than it goes down. So if you drop $6,000 in on day 1, there's a good chance you'll be ahead after a year. But here's the problem. Most people don't have $6,000 just lying around, and even if they did, most wouldn't feel comfortable investing it all at once. They'd hesitate, they'd wait for the perfect time, and often miss out completely. That's where DCA wins. It's not about squeezing out the absolute maximum returns, it's about actually staying in the game. It keeps you consistent, disciplined, and invested through the ups and downs. Because the biggest risk in investing isn't missing a few percent of growth, it's quitting altogether. Let's look at real-world history. First, we have the 2008 global financial crisis. The market dropped nearly 40%. Lump sum investors panicked and sold, but dollar-cost averagers kept buying cheap shares. Within 5 years, their portfolios had recovered and doubled. Or we can look at the more recent 2020 COVID crash. Stocks fell 30% in weeks. Anyone who stopped investing missed the recovery. But DCA investors who kept putting in money saw their portfolios bounce back and hit new highs by the end of the year. The lesson? Timing feels good in hindsight, but in real life, discipline beats guessing, which brings me perfectly to the next point. This is where the real power of dollar cost averaging lies. Psychology. Investing is emotional. Fear and greed ruin more portfolios than bad stocks ever could. DCA gives you rules to follow. You don't need to think. You don't need to check prices every day. You just buy on schedule. It's like a subscription service, except instead of paying for Netflix or Spotify, you're subscribing to your own financial freedom. And the longer you stay subscribed, the more wealth you build. I don't know about you, but I'm definitely a subscriber to that. But there are mistakes to watch out for. Actually, 3 key ones that you must remember. Number 1, buying random companies. DCA only works if the company or index you bought grows over time. Always research before you invest. Number 2, stopping too early. The magic of DCA happens over years, not months. Quitting after one bad dip destroys the benefits. Number 3, using money you can't afford to lose. Always invest with spare money, not rent or emergency savings. Actually, you should have an emergency buffer way before you even start investing, but that's another lesson for another day. So if you can avoid these 3 things, then DCA becomes one of the safest, simplest wealth building tools available. And that's the beauty of dollar cost averaging. Even if you know nothing about timing the market, you can steadily build ownership in a company and earn returns through both capital gains and dividends. It also removes a lot of the stress. You're no longer asking, is this the perfect price to buy? What if it drops tomorrow? Or staring at charts without really understanding them. With DCA, you just stick to your plan. Buy at regular intervals, at whatever the price is that month, as long as it's within your budget and with spare money. In our vanilla bank example, we happen to see a profit in just 1 year. But remember, that's short term. Dollar cost averaging works best over the long term. 3 years, 5 years, 10 years or more. And Warren Buffett himself supports this mindset.
The important thing to do, if you have an overall feeling that business is a reasonable place to have your money over a long period of time, is to invest over a long period of time and not make any bet implicitly by putting a big chunk in at a given time.
The only catch? Don't buy random companies. Always research the stocks you are planning to buy before you invest. So now you know the simplest way to buy stocks without worrying about timing. The next step is putting it into action. That's exactly what I cover in my free investing masterclass. Inside, I'll walk you through everything, from picking your first stocks to building a portfolio you can actually retire on. It's 100% free and you can watch it right now using the link below. I'll see you inside.